Audit risk assessment is one of the most critical stages of the audit process because it enables the auditor to identify areas where material misstatements may occur and to design appropriate audit procedures in response. International standards on auditing, particularly ISA 315 identifying and assessing the risks of material misstatement and ISA 330 the auditor's responses to assessed risks, require auditors to obtain an understanding of the entity and its environment, including its internal control system, in order to assess risks at both the financial statement and assertion levels. Effective risk assessment allows audit resources to be allocated efficiently, supports the application of professional skepticism, and enhances the likelihood that material misstatements arising from fraud or error will be detected before the auditor expresses an opinion on the financial statements. Audit risk is defined as the risk that the auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. The audit risk model consists of three interrelated components: inherent risk, control risk, and detection risk. Inherent risk represents the susceptibility of an assertion to material misstatement before considering related internal controls and is influenced by factors such as complex transactions, management estimates, significant judgments, or industry conditions. Control risk is the risk that a material misstatement will not be prevented, detected, or corrected on a timely basis by the entity's internal control system. Detection risk refers to the possibility that audit procedures fail to identify existing material misstatements. Unlike inherent and control risk, which arise within the client's environment, detection risk is managed by the auditor through the nature, timing, and extent of audit procedures. Collectively, these three components determine the overall level of audit risk and influence the audit strategy adopted by the engagement team. Financial statement audit risks may arise from numerous sources and require tailored audit responses. Business expansion into unfamiliar markets, complex accounting estimates, related party transactions, revenue recognition, impairment assessments, inventory valuation, and going concern uncertainties all increase the risk of material misstatement. Fraud risk is particularly significant in areas involving management judgment or opportunities for earnings manipulation, such as premature revenue recognition or understatement of liabilities. Where high inherent risk exists, auditors should increase substantive testing, obtain more persuasive audit evidence, involve experienced staff or specialists, perform unpredictable audit procedures, and maintain heightened professional skepticism. Where weaknesses in internal controls increase control risk, auditors may reduce reliance on controls and perform additional substantive procedures at year-end. Thus, audit responses should always be proportionate to the assessed level of risk. Materiality is another fundamental concept underpinning audit planning and risk assessment. A misstatement is considered material if it could reasonably be expected, individually or collectively, to influence the economic decisions of users taken on the basis of the financial statements. Materiality is therefore based on the needs of users rather than the size of the individual error alone. Both quantitative and qualitative factors must be considered. Even relatively small misstatements may be material if they affect compliance with loan covenants, alter reported profits, conceal fraud, or influence key performance indicators. Materiality is determined during audit planning but remains subject to revision if new information becomes available during the engagement. The auditor applies professional judgment in determining appropriate materiality thresholds based on the characteristics of the entity and the expected users of the financial statements. Closely related to overall materiality is the concept of performance materiality, which represents an amount set below overall materiality to reduce the probability that the aggregate of uncorrected and undetected misstatements exceeds overall materiality. Performance materiality provides a safety margin that recognizes the possibility of multiple individually insignificant errors accumulating into a material misstatement. In practice, audit firms commonly establish performance materiality at between 50% and 75% of overall materiality depending on assessed audit risk, internal control effectiveness, and previous audit experience. Lower performance materiality results in more extensive audit testing, while higher performance materiality may be appropriate where audit risk is assessed as relatively low. Calculation of materiality requires professional judgment and consideration of appropriate financial benchmarks. Common quantitative benchmarks include profit before tax, revenue, total assets, total equity, or gross profit depending on the nature of the entity and user focus. Typical guidelines include approximately 5% of profit before tax, 0.5 to 1% of revenue, 1 to 2% of total assets, or 1 to 5% of equity, although these percentages are not prescribed by auditing standards and should be adjusted according to circumstances. For example, where profit before tax equals $4 million, planning materiality using a 5% benchmark would be calculated as $200,000. If performance materiality is established at 70% of planning materiality, the resulting threshold would be $140,000, meaning that audit procedures should be designed to detect misstatements exceeding this lower amount. During the audit, all identified misstatements are accumulated and evaluated collectively against overall materiality before the auditor reaches a final conclusion. The relationship between audit risk and materiality is inverse and forms the basis of audit planning. Higher assessed audit risk generally requires lower materiality thresholds and more extensive audit procedures, while lower audit risk may permit higher materiality levels and less extensive testing. Auditors continuously reassess risk and materiality throughout the engagement as new evidence emerges, revising audit procedures where necessary. A comprehensive understanding of audit risk components, financial statement risks, materiality, and performance materiality enables auditors to design effective audit strategies, obtain sufficient appropriate evidence, and issue reliable audit opinions that enhance stakeholder confidence and uphold the integrity of financial reporting.